Welcome everyone, my name is Oli Hochberg. I'd like to start this video by asking you a question. Obviously you're not here for my good looks or to listen to my jokes, although I've got some very good ones. And you're probably here to learn about trading and investing in the stock market. But let me ask you, what is the main reason for you to want to know more about trading? What would you do with that knowledge? And what's the goal that ideally you're trying to achieve? For instance, I'll tell you, for me, trading was my way to become independent and change my lifestyle. I wanted to keep on doing what I love to do, but I wanted to be able to manage my time the way that I wanted to, away from my regular 9 to 5 job. That's why I really wanted to become an independent trader. And look, in my years of experience, I've noticed that most of the time, people are aspiring to some kind of financial independence, long-term financial security. And the earlier they can get to it, the better. Obviously, financial freedom or financial security mean different things for different people. But I strongly believe that trading and active investing is one of the paths that can create that extra $100 or $200 a day, or even a lot more. And I know that all these extra can quickly add up with time.
So today my goal is to teach you by the end of this video my 3 greatest tips on how to generate this kind of extra income from trading. So personally, I've been working from a home office ever since I decided to leave the city of London about 15 years ago now and moved my family to Greece. It was like a new beginning for all of us, and to be honest, it was mostly my experience, knowledge of trading which enabled me to do all of that, because trading is one of these few activities out there where you can really generate a decent income while being located anywhere you want. And also, I truly believe that it's never been so easy for retail traders like us to make the jump. So simply because the tough, the most the barriers of entry have all gone down. So, and by that, I mean we got zero commission brokers, we get internet access everywhere. We can trade any financial instruments from smartphones, tablets, laptops, anywhere, anything you want. So on any stock market that we want, which was not the case merely like 15 years ago. So the cost of entries and the logistics, the everything has become a lot more accessible to the small investor like us. And so perhaps some of you are also at this crossroads right now. Perhaps financial markets and trading have always been something that you've been interested in and but never really got a chance to dig into. Perhaps you're looking for a way to become more actively involved in your personal investing process towards building your financial future. Or perhaps you're also thinking that further down the road you'd like to make the cinema jump like I did and start working for yourself as an independent trader. And regardless of your experience, right before we get going, I just want to reassure you that this video is really geared to everyone, being new starters to the game, but also more advanced traders. And so even if you don't know much, or you know very little about stock tradings, while with some education, you can definitely reach the same sort of success that I or my students have managed to. Now, before we really get going, and for legal and transparency matters, I must show you this disclaimer, which basically states that trading is risky, blah blah blah, and also warn you that I'm not an investment advisor. I'm not registered to give you advice on your investments, nor to manage your money. This is just not what I do. It's important that you understand this. Although I used to be registered to trade on behalf of institutional customers in the past. Now I'm not registered to do that anymore. All right, so let's jump into it. And so in this video, we will cover my 3 secrets to successful trading. And I know that the title sounds impressive. I should have introduced it with some kind of epic soundtrack or something like that. But however, joke apart, I want you to understand something very important. There is no secret or magic formula about trading. Anybody trying to tell you otherwise is simply a liar. But on the other hand, there are definitely ways, there are techniques that, if implemented correctly and consistently, they will lead you the way to become good at it and making money from it. Again, there's no holy grail, but applying a methodology, common sense, hard work, that's what will lead you to success and making money in trading and investing in the markets. And like in any other field of activity, you'll need to learn. The same way that pilots they don't start flying from day one, or medical students they don't operate on patients right away. Thank God. Um, then, in a similar way, learning how to properly trade stocks and invest actively your portfolio requires the same sort of initial learning process, so that you don't hurt yourself by doing stupid things from the start and risk losing all your savings you worked hard for. And unless you prepare yourself the right way, then I believe that the odds are not going to be in your favor. If you look at many different studies throughout time, you'll notice that almost 70 to 90% of people fail at trading. These are real statistics. In fact, you should look at the small prints in the footers of all of the major CFD brokers' websites, because by regulation now, they have to disclose the percentage of losing accounts that they operate. And look, my goal is definitely not to discourage you or to frighten you from the start, but at the same time, I really don't want to sugarcoat you and tell you lies, because the reality is that trading requires dedication to learning, and I can tell you from my own experience that when you get started not knowing much about trading, then you end up paying the heavy prices for not learning. I personally blew quite a few small accounts when I got started in this business, and I was young and I was impatient to make lots of money trading. And thank God that I was young and with not a lot of like money and resources, because surely the fact that I didn't have much to trade back then actually saved me from potential big losses. So trust me, I know what it means to get started while not being fully prepared. And to be honest, what actually saved me was the fact that I was surrounded by experienced traders who could mentor me uh, most of the time. So by now you might wonder what qualifies me to teach you about trading. And look, I'm not gonna bore you about all the details, especially that you can find most of the details on our website, or if you check my LinkedIn profile. But in a nutshell, I started trading my trading career in 1991, working for a major financial institution in Wall Street, until I decided to move to London to eventually join Cantor Fitzgerald and BGC Partners, where I became a partner responsible for European high yield trading department. So during the course of my career, I probably traded an equivalent amount of a few $1 billion in futures contracts, foreign exchange, bonds, stocks, etc. So throughout these years, I was featured in Reuters articles, Bloomberg Financial News, Bloomberg TV. That's me, you can see there, looking very nice with my tie, etc. And it brings us back to now, where I've been working on my own as an independent trader and managing my own money. And recently I started eTrading Academy about 8 years ago, which has become my educational project focused on trading and investing. But enough about me. I want you to know that working with small groups of people along the years really made me realize how often can people start off with misconception about markets, and also how much they can be irrational when it comes to investing. And it's not a fault on their own, because I think that our system of values, our society, has fed our brains with a bunch of nonsense and myths about the way we should invest or trade. And so there's a lot of work to be done out there in order to demystify, to reprogram the way that most people feel or think about the markets and the way they take action in the markets. And the reality is that you don't need to rely on so-called specialists to make money in the markets. All you need really is all you need to do is to read a few good investment books, attend some seminars or investment classes, anything so you can build your knowledge and confidence and learn how to invest using sound principles, proven rules and methods that can build your investment portfolio over time, but also help you to protect it from the bad times. And yeah, like I said before, when I first started trading, I made most of the same mistakes you've probably made. But after 30 year plus, being in this business, I can tell you that I've learned a hell of a lot from my own mistakes and the mistakes from my fellow traders around me. And I must tell you that if you want to be successful at trading and investing, first you'll have to get rid of many of these bad habits of yours, which will feel very unnatural at the beginning. And I will explain you what I mean by that. For example, because it is in our human nature to want to be right most of the time, then we try to avoid taking loss because it hurts. It hurts our ego. It hurts to admit that we were wrong. So we stay in a trade that has the potential of losing more and more money and perhaps ultimately eat up all of our accounts. Also, because we are impulsive people and we don't like to plan everything in advance, so we lack a plan. And unfortunately, successful trading requires a very, very strict planning. Also, for instance, because by nature we humans are greedy, we always stay too long in positions thinking that the profits will just keep on piling up. But the reality is that they don't. And at some point, the market turns around and we just freeze. We start watching the market reversing all the way down because we didn't have an exit plan. We didn't have a plan as when to sell or also because we like to buy things on the cheap. It's so totally unnatural for us to bring ourselves to buy a stock making an all-time high. However, this is exactly because this stock is making a new all-time high and outperforming every other stocks that we should concentrate on this one rather than wasting time and money into these bad performing stocks. Look, these are just a few examples of our natural inclinations that are part of our psychological ingrained, I would say, bad habits, which makes us our greatest enemy to profitable trading. Buying on the way up, cutting losers fast, having a defined strategy on how to manage our trades, all of these important rules are, I mean, they get mentally blocked out because we don't feel good about them. But again, to be profitable in trading, we need to do the right thing and not the things that feels right, if you see what I mean. And don't worry, you're not alone. And even the most successful and experienced traders still fight against their bad habits every day. It's a long learning process for every one of us out there. But the start of our successful journey is to be able to recognize our biggest flaws, our bad habits, and act towards not repeating them. See, human nature and the psychology of crowds, they have essentially remained the same over time. And they are directly reflected in the price action volume that you see in the stock market. The same technical price patterns that you see in the market, they just keep on repeating themselves throughout history. And so the same financial bubbles, the crashes, just keep on coming. It's just that, we call them with slightly different names. But fundamentally, they're more or less the same as what they were 100, 200, or 500 years ago. So the techniques that I want to teach you today, they're timeless. They do not get out of fashion no matter what happens. And once you understand that, you need to change your natural inclinations. Um, and if you're willing to do what is right and not what feels right, then if you're willing to basically study through hundreds of price charts, learn about the price patterns, and then I can promise you that you'll be on your way to successful trading and investing. So with that in mind, let's jump right into the main topic of this video. And we will start with my number one trading concept, sitting at the top of my list, the four pillars of trading: psychology, risk, position, and money management. I kind of gave it the acronym PRPM. Yeah, I'm proud of that. And I know what you're thinking right now. Is going to start boring us with his blah blah around about how risky trading is. But let me tell you this: we learn to preserve our capital first in order to then be able to make the real money. Um, then we go on learning to practice our strategy. Capital protection is our number one priority. And then everything unfolds the way it is supposed to. I want to start by sharing this superb quote from this very famous hedge fund manager. And it kind of sums up everything about trading, but it also can apply to many other aspects of our life. If you don't bet, you can't win. If you lose all your chips, you can't bet. It's beautiful, such a simple way of putting things, but so correct in many, many ways. Because in life, we take risk in almost anything we do. When we cross a road, we take a risk. When we take a plane, we take a risk. When we open a new business, we take a risk. Somehow, in anything we undertake, we have to be careful not to take overrated risk, because otherwise we might risk to lose it all. And so that is why we must first concentrate on how to protect our chips and then focus on how to multiply them. So really these four pillars are essential for any serious investors and traders. They are the strongest foundation for starting your trading or taking it to the professional level. And funnily enough, risk management is the one ingredient that most beginner traders forget about or they dismiss from the start. Instead, many they think it's okay, I can manage. First, I can trade, then I can press the buy or the sell button, then I'll kind of worry about if it starts turning upside down. So they start with the immediate assumption that they will be successful, that whatever they touch will automatically turn into gold. But if it turns out to be a loser, they don't really know how to deal with it because they didn't plan for it. And on top of that, most of these traders, they think that surely, it must be the market, which is wrong because, they couldn't possibly bring themselves to think that they could be the one being on the wrong side of the market. People don't want to question themselves because somehow it hurts their ego. And that's essentially what separates basically the pro trader from the novice. For the professional trader, the first priority is about how much he can afford to lose on any particular trade. And once he understands the risk, then he looks at how much he stands to potentially make if things go right. And then he decides whether the opportunity is worth a trade or not. Everything, all his process is planned in advance. And the reality of trading is that each trade is simply an edge with a random outcome. That means that statistically, each trade is independent from the other. So whether a particular trade is a winner or a loser, it is irrelevant in the grand scheme of things because what matters really is the positive edge of his strategy and how much he can expect to gain from it over time. But remember that in order to succeed and profit in the long run, it has to be right. It has to be the right balance between what it stands to lose versus what it stands to win. So you see, what you really need is a combination of having a slight positive edge in the market and making sure that you control the risk, because if you don't, then you will run the strong possibility of blowing your trading account even before having even enough time or opportunity of making it. And so we go back to making sure we always keep enough chips in reserve available for betting. Otherwise, we don't have anything to do. If we run out of chips, then we can't play the game anymore. And what I really mean by having a positive edge in the market is that we have a methodology, a tested system of rules that needs to be followed before taking on any trades. So it might be that, we're 40% of the time correct, or 50% of the time, or higher. The better you become at it, the more consistent and higher this number would be. But the important thing is to have a system with this tiny little edge. And I'm sure you guys, you've heard of the good old saying, the house always wins. Well, in the exact similar way that the casino has a slight hedge of all, perhaps like 3 to 7%, depending on where you play the roulette, which by the way, this small edge has made casino owners very, very rich over time, then we need to trade with that edge. Um, this hedge that I'm talking about in trading is part of two key metrics that you'll have to monitor very closely. The first metric being your win ratio, and that means basically how many trades on average do we win versus the ones that we lose. And the second important metric is our payoff ratio. And that means how many dollars on average do we make for every dollar that we lose. So to use an example, say we make an average of on average $200 on our winning trades and we lose 100 on our losing trades. That would make that payoff ratio equal to 2 to 1. And as much as we can not control the outcome of our trades, like I said before, whether a trade will turn into a winner or not, the only one thing that we can actually control with a pretty decent degree of confidence is how much we're willing to lose on any single trade. And personally, I even go further by setting myself a maximum loss for any single day, week, or month. So it is this set of rules that make up my risk management. It acts like my trading account firewall. It is like here to protect me from my own financial self-destruction. And because by keeping a tight risk management, I can keep my boat afloat no matter what. Even if the ultimate ending is to blow your trading account, this rule will keep you in the game for a long, long time. Long enough that in the process you will understand your biggest weaknesses, what you're doing wrong, and the areas where you need to improve in order to be successful and profitable. So now I hope that I made it very clear that we first and foremost need to establish our risk control. And but I'd like to show you how in reality we can use the power of these key metrics and statistics to our advantages. So let me pull out this spreadsheet. And so on this table, on the horizontal top, highlighted in blue here, we get the win ratio that we just talked about, the average percentage of winning trades versus the losing ones. And on the left column, we have what we call the risk to reward ratio, also known as the RR. So this risk reward ratio is very similar to the payoff ratio that we talked about just before. Let me explain. Remember that I told you that when we look at any potential trade, we need to decide how much we're willing to risk, and if we're wrong, how much basically we stand to make, if we're right. So um, that's our risk reward. I decide basically to bet to risk $1 versus, let's say, the possibility of making $2 if I win. And as you can see throughout this table here, as long as we stick with trades offering a 1-to-1 ratio and above, most of the areas of the table are green or yellow, which means that we're profitable or we're breaking even no matter how wrong we can be. So my first number one rule of risk management, you should never, ever consider a trade that offers anything below a one-to-one risk to reward ratio under no circumstances. And if you can stick with trades offering a ratio of 2 to 1, so again making on average $2 for every $1 we put at risk, you only need to be right 33% of the time in order to break even. I.e., let me reformulate this another way. We can be wrong 67% of the time and still come out okay, i.e., break even, if we stick to trades paying $2 for us and for $1 that we bet. Now, let me ask you, have you ever heard of that before? Certainly, you've not been told about all these things by popular media or even most of the academics. And as for me, personally, I was never taught that at business school. I had to wait till I met with my original bosses and mentors in New York to learn about this. They taught me about it because originally I thought, perhaps like some of you do, that I needed to be right 80 to 90% of the time in order to make money at trading. But then I suddenly realized that it was not the case. So these numbers, they're not random. These statistics, they don't lie. They are real and they work in real life, in real trading. And if you don't believe me, if you're still skeptical about this, then just Google the stats of the most successful traders or hedge funds with long track records. You will realize, like I did years ago, that even if you're wrong 67% of the time, you can still come out very profitable in your trading as long as you pick the right trades offering you a 2 to 1 risk reward ratio or higher. Um, the great Wall Street speculator Bernard Baruch used to say that you could be right only 3 or 4 times out of 10 and still be very profitable if you knew how to cut your losses quickly and let your profits run all the way, so that to achieve this risk reward of 3 or 4 times more. So I know it's kind of like, it sounds illogical, but it is a reality of trading, because trading is a game of numbers, just like at the casino. So please try your best to get rid of any misconception about this world of investing. And God knows that, how many misconceptions we nurture since, we were kids. We've raised we've been raised like very competitively. Our parents, the school systems, the society, they've all tried to teach us that we have to be right no matter what. The system has kind of brainstormed us that making mistakes is not a good thing. But I'll tell you this: it should not be like that, neither in life nor in trading, because we learn tremendous lessons from our mistakes and bad trades. And also because in trading, if we are consistent, if we stay disciplined to our risk management, then we can still be successful and profitable despite being wrong lots of times. But now I want to go a step further and show you that, contrary to common belief and what you can see all over social media, not only you can be very wrong very often, but you don't even need to trade big size in order to run a profitable trading business. So in this simulation I'm showing you in this table, I play with a multi-dimensional aspects of the key metrics that we just talked about and their impact on our return on investment, or ROI. I will spare all the details, but in a nutshell, if you look at what I consider to be the sweet spot between 1.3 to 1.5 for our risk reward ratio, which to me represents a more realistic and achievable target for the average risk reward based on many trades that you're going to take, then I can aim at generating around 100% return per annum. And so, to summarize, being ready to lose $1 to make $1.40 on average, and being right 60% of the time, so being wrong 40% of the time, I can achieve around 100% return on my investment in my accounts if I use a strict risk per trade of around 1% of my start account value. And if I manage to execute one trade per day on average, meaning entry and exit on the same day, during 48 weeks of trading per week, I'm allowing ourselves 4 weeks holidays. So again, for those of you who haven't been told that, or I would say no, for those of you who've really been told that you need to trade big size, that you need to trade a big account or leverage your account to make money and achieve performance, then look again at the results of this table and start to rethink about it, because it should be clear by now that you can risk a relatively small percentage of your account size, less than 1% of risk per trade, while at the same time being wrong 40% of the time and still come out profitable. And I want to say that, I want to precise that, 1% of risk doesn't mean that you restrict yourself to spend only 1% of your account. I want you to understand that the difference between saying that we want to risk, say, 1% of our account versus the actual size of the trade that we can take. These are two very distinct things that sometimes people have a hard time to understand, but we're going to get to it in a moment. And as a matter of fact, it is a good segue to turn to the second feature of my core concept number one, which basically is money management. I missed that page. Sorry, guys. So going back to money management now. What is money management all about? And money management is all about finding what is the right position size for your account. So as we've just discussed, I first set myself a maximum risk per trade, say 1% of my account. Then whenever I'm about to enter a position, I must have a predetermined level of exit. That is, I must know where I'm getting out before I even get in. We call that level the stop loss. And that's the point at which my trade has lost its rationale for still being in position. And that's the point at which I'm willing to stop myself out, or, get out of the trade, even if it means that, I'm going to take a small loss. And by the way, that's how you keep your losses small, by not letting them to get out of control, by forcing you out of the trade when you're wrong. So the position size is directly determined by the stop loss and my maximum risk per trade. But let me run through a quick example here. So let's say that I'm willing to risk up to 1% of my account on any single trade. So say my account is 10K to start with. So based on the size of my trading account, I shouldn't allow myself to lose more than $100 on any single trade. Again, it doesn't mean that I will buy for only $100 worth of stock. It's just the amount of money that I'm willing to lose if I'm wrong on any single trade. And let's assume that I've decided that my stop loss should be, say, 50 cents below my entry price, meaning that I'm willing to lose 50 cents per share before admitting that I'm wrong. So with all that information, I can then calculate the maximum amount of shares that I should allow myself to buy on that trade. So that would be $100 divided by 50 cents. That means 200 shares. So in this example, I would risk $100, which is my 1% risk per trade based on my account. But it doesn't mean that, I can only invest $100 only in this stock. If the price of the stock was $10, that would mean that, I would have to spend $10 times 200 shares, or $2,000 to buy that stock position. And but I still want to risk $100 only off that amount, which means that once my position value is below $1,900, I want out. So now that I bought my 200 shares, what do I do with them? What's the plan? And so another crucial dimension of money management is about how I'm going to manage my open position, how I'm going to manage my trade. And so we're going to talk about position management. And position management is all about thinking exit strategies, meaning that the trade that we carry is already profitable, and so we need a plan on how to manage our paper profits through techniques such as taking partial profits, time exits, trading stops, stop being moved at break even, etc., etc. So setting these exits strategy plans help me to find out whether I can get a minimum risk reward ratio of 1 to 1 and whether I can afford to take any particular trade. So by looking at this chart now, I estimate that 50 cents is a good level to put my stop loss below my entry price. So at $9.50. If the next technical level on my chart shows an area where the price of the stock, could meet some resistance, but still provide me with a potential profit of 50 cents, where I could basically start taking some partial profits. So let's say at $10.50, then that means that I could achieve my minimum required risk reward ratio of 1 to 1. And I could go ahead with that trade. And then part of that trade, part of my trade management, I would keep part of the left position and aim at the second area of profit taking, let's say at around $11.25, again, based on my technical analysis. And if I manage to take profits there, that would mean that my risk reward on that trade has turned to almost 1 to 2 ratio, because I took 50 cents profit on half of my position, and then another $1.25 on the other half, which would bring the total average profit per share to $1 compared to my 50 cents initially risk at the beginning. So I can't even begin to tell you how this aspect of position trade management has like literally changed my life over the years, because when I realized how much money I had left on the table over the years simply because I was constantly trying to swing for the fences, or simply, being stubborn and holding on a bad trade for too long. After reviewing hundreds and hundreds of trades, I realized how important it was, at least for me, to scale out of my positions and be able to take partial profits, i.e., to cash in more often and remain at break even on the rest of the open position. It mentally it helped me a lot to hold on my trades longer. That was that key moment when my trading changed from being like average to being consistently profitable, by understanding that it was generally better to take some small profits along the way rather than going for the big home run trades. In in general, I feel that investors are very bad at knowing when to sell. And again, it's mostly because they get into a trade without having an exit plan from the start. So you see, we covered risk, money, and position management. But all of that is only effective if we have the right psychology, the right mindset to start with. Because all of these rules are only as good as the person having to the will and discipline to follow and execute them. And I'll explain why psychology is such an important element and the fourth pillar of this PRPM core concepts for successful trading. Because trading is a game that takes place in your head. It's not you against the market, it's just you reflecting who you are in the market. And to that extent, to that end, it's also one of the main reasons why a guy that can mentor you, that can accompany you, is important at the start of your journey, because this trading game is so psychological that at the end of the day, traders need to talk and constantly exchange with a trusted person who can see through them, someone who understands the business and who can quickly, adjust, the position, or basically make sure that they're doing the right thing. So in conclusion, let's quickly recap what we've learned in this first set of essential trading concepts. You need to remember the following. You need to respect your risk. Number one. So set yourself a maximum risk per trade set as a percentage of your account. I would recommend anything between like 0.1, 0.2% to 0.5% to start up with stocks with a maximum exposure of around 5%. You can double that for ETF because they are less volatile. Talking about non-leverage or other type of exotic ETF. Then we need to add layers to our firewall. So we set ourselves a max daily loss capped at 3 consecutive losing trades. So the moment you eat 3 losing trades in a row, you're done for the day. And we also set a max weekly and a max monthly loss. Again, all these limits, those rules, they act like a firewall to protect your trading account, mainly from yourself. So if when your max risk limits are reached, then trading must be stopped for the rest of the day, the week, or the month, depending on which max loss comes first. Also, by 5% nominal exposure, I mean you can't have more than 5% of your account on any single stock. So if you have, let's say, again, an account with 10K, that would mean that your maximum dollar exposure to a particular stock should be $500. If the stock trades at a price of $5, you can only buy 100 shares. Or if the price is much higher, you could trade fractional shares if you want. All right, now we will recap the key metrics that we need to follow up in our trading. But when you start, aim at being consistent rather than making money. That's the most important thing, because what you need at the beginning of your trading journey is to fully understand the methodology, to apply the process and follow a consistent approach. This is the most important at the beginning, even more important than than lose money. And once you start reaching 2 or 3 months in a row being flat or slightly profitable, slightly positive, that means that you've started being more consistent in your trading, and you might be in a position to slowly start increasing your risk per trade and slowly scale up your game. So we need to aim at a win rate of about, say, 50 to 60% to start with. That's our edge in the market, like I've said before. That is our extra probability that keeps the odds in our favor. The ultimate goal being to reach an average of about 70-75%, which is where you'll find most of the profitable pro traders. And finally, we stick to tech trades offering a minimum of a 1-to-1 risk-reward ratio, like we've discussed, with the ultimate goal being to get to an average of 2-to-1. This core concept number one of preservation of capital and consistency, they are key in trading. And remember something essential. Even small but consistent gain add up quickly to make big money in your account, especially if you're good at keeping your risk under control and avoid, these big losses. So now let's turn to my secret number 2 to successful trading, the 3 core strategies and a system. So I use 3 core strategies as part of a complete system called the multi-time frame conversion system, also nicknamed as MTFC, which basically combines all of our core strategies, all of our risk, money, position management rules, but looking through a broad spectrum of time frames. So we'll go over these core setups and the system, and I'll explain you roughly how they work together and what they intend to do. And I reckon that, from this summary, you'll get a good starting block for your trading, especially if you're not already using some of these setups. But before we go any further, you gotta you gotta understand that I use technical analysis and not fundamental information, and that is like I base all my rules of trading on technical analysis. So apart from being aware of general news or any upcoming economic data or earnings report, my main concern is the price and the chart in front of me. And so for those of you who are totally new to the concept of technical analysis, which I could understand, you've never seen any charts before or you don't know exactly what they mean, I want to introduce it very, very briefly. So that everyone can be on the same page and understands how to read a very basic chart. It will only take, a couple of minutes. So let's look at what I wanted to. So most traders basically these days they look at these charts using Japanese candlesticks. Each candle contained four main points of information: the high, the low, the open, and the closing price of the stock. So on the left, you can see a typical green up candle, meaning that the closing price is higher than the opening price. That's a reverse for the red candle. And on the right, then you can see what a typical chart look like. So here we have basically the weekly chart of the New Zealand dollar per US dollar. So there's a NZD USD. That's the and where each basically candle shows the price of action for each single week, red or green. Keep in mind that the unit of time under consideration could be anything. Right now we're looking at a weekly chart, but it could be 1 minute, 5 minutes, 60 minutes, 1 day, etc., etc. So each candle represents the opening, the closing, the high, and the low price for this chosen unit of time. Also, another common feature that you find on these charts are what we call moving averages, which basically simply help to average and smooth out the price data and can be calculated over like any specific period of time, being again daily, weekly, or minutes. And the most popular moving average used by traders usually are the 20, the 50, the 200 moving average that you can see appearing on this chart here. Again, the idea today is to brush a general picture of my main core system and strategies and how they interact with each other in order to basically form the complete methodology that I use. So let's get into it. First, let me remind you something very important. There's no magic indicator. There is no magic strategy that works all the time. All strategies are building blocks to a trading system. And that is why, I use the mix of these three core strategies that can be adapted to many time frames. So these three core setups, cover the broad spectrum of market configuration, and they basically offer us several ways to trigger entries to our trades. So the first strategy that I use is called the MRW. It stands for Major Reversal Warning. This strategy basically tries to pick major turning points in the markets. In concept, it is a contrarian strategy because we tend to go against the recent prevailing trend, trying to call a major turnaround or top or bottom. And this strategy clearly has a lower win rate than the other two setups I will discuss, but it offers a much higher reward. So let me show you on the chart what I mean. So these basically are the sort of major areas where the market will turn and have major reversal. As you can see. Now, the other strategy that I use is called, denominated like in a funny way, breaking loose. Reminds me of footloose, and is a typical breakout strategy. where we're playing the pushing through major points of price resistance or support. And we're betting on the continuation pattern of this breakout. So I'll show you also what I mean by that. It's basically, areas like here where we're going to basically break some important major points and keep on going on, or here. All right. And now the final setup that I use, final strategy that I use is called the B2T, the back to trend. So it's basically a trend following strategy where we essentially play the major ongoing trend of a stock. And it is probably my favorite strategy because, I've always been like a trend follower at heart. And I believe that, above all that, the trend is your friend. By the way, if you haven't seen that video, I will maybe, give you a link of this trend is your friend video, which was a pretty nice video to watch, a much shorter video that you'll find on our YouTube channels. Also, I mean, generally speaking, this strategy, when applied correctly, offers the higher win rate of all three. So I'll show you on the chart the sort of things that basically we're looking at, pull back, pull back, pull back, pull back, pull back, and these sort of things, that in order to basically enter and get back in the trend. Now, let me go back and introduce you to the multiple time frame conversion systems that I've mentioned just before. So, what do I mean by multiple time frame? Financial markets usually consist of huge crowds made of very different players. And like I said, the way that I look at it is through the lenses of technical analysis. I'm looking at the price action. So, in a way, everyone's emotion, fear, greed, including yours and mine, they all filter through the price action. And the volume that we can study on the charts, everything basically comes through on that technical analysis. And because markets are so complex and players are so different that we need more than one time frame to study them properly. But the problem is like, many people think that they can focus on only one time frame, like let's say the daily charts, or perhaps even like shorter time frames. Like we see a lot of guys playing on the 1 minute or the 5 minutes bar chart. And that is why most of these guys tend to lose, especially if they focus only on the shorter time frames, because they miss the big picture. They and not only that, I mean they get messed up because they keep on basically switching time frames. So one day they might look at the daily chart. The next day they might look at the 5 minutes bar chart. So sometimes, one chart looks bullish, the other one looks bearish. And the result of this confusion is that their decision making process is a total mess. They just don't know what to do and where to look for, when to enter or exit a trade. Remember, my first warnings earlier in this video was that the highest rate of failure and frustration in trading mostly comes from the fact that people lack a methodology. So first, you need coherence in your trading. You need a complete roadmap or template to guide you through the maze of markets. And for that, the multiple time frame convergence helps to evaluate the context of the market, meaning, it helps us to understand at point X in time where we are in the grand scheme of things. And for that reason, we need to pull ourselves away from the market instead of like getting our nose like stuck to the window. So we can get the big picture. We can basically then micromanage the trade on the smaller units of time. So let me run you through a real example of the MTFC system. So we'll look at an example of a swing trading, which usually is a type of trading that holds trades for medium term, like 2, 3, or more days. But keep in mind that we can adapt this MTFC to any type of trading, like day trading, etc., etc. Anyway, this example looks at a stock called Arrowhead Pharmaceutical, the symbol being ARWR, and here I will use a multi-time frame combination of a daily and a 1 hour chart. So the first chart we're looking at is the daily bar chart. We call it our screen number one, which helps basically to it helps us to get the big picture and to find out about the ongoing major trend, which ultimately sets our strategy as to what side of the market to play. So being long, i.e. buying the stock, or short the stock, i.e. to sell the stock. So on my screen number one, I always look for a nice convergence of factors that will help me identify this ongoing trend. And so on this chart, we can notice like the steady rise of the price in a stock price, making higher highs and higher lows, the Dow theory, along with like a nice convergence of moving averages rising steadily, and the stock price trading mostly above the 50 and the 200 EMA moving average. And after a month long of price correction and around that important area of multiple supports, such as the original price supports, the moving average, etc., we trigger a nice MRW, or major reversal strategy entry signal. So now that our screen number one is like screaming out loud that to be on the long, on the buy side of the stock move, then we turn to our lower unit of time, and it's going to be like say our 1 hour bar chart, also known as like the screen number two. And the idea is to start looking for entry points in the direction of the tide, but when the wave goes against the tide, which really represents the best risk reward entry points that you can get. And we can find some good points of entries indicated here at the bottom of the chart, where we can see those big green arrows pointing out to oversold levels on the oscillator, and at the same time we find a nice convergence of support levels and with the moving averages giving us like basically our first series of pullbacks, triggering like the B2T, the back to trend entries. Also we can find nice triggers of breaking patterns as shown on the screen as per our breaking loose strategy. So you see, the advantage of the combination of multiple time frames is that it helps us to organize our thoughts in a constructive way, and it really forces us to trade within the main direction of the market, either looking for mini counter trends, pullbacks, or breakouts coming out of these pullbacks, giving us like multiple points of entries. So to summarize, the screen one gives you the trend direction on which you must be trading on screen number two, but you use counter trend in screen number two to get back within the main direction of screen number one. Now, for those who have a bit more time to dedicate in front of their screen during the day, then if you're interested also in day trading, you can find more granulation and you can fine tune the trade entry point using a shorter time frame, such as like say the 15 minutes or the 10 minutes bar chart. When I'm talking about fine tuning, I mean to say that by going a step down from the 60-minute bar chart, we can find like some slightly better price entries and tighter stops. So if we look at the split windows, which displays the 60 minutes and the 15 minutes side by side here, we can see that the oversold area on the 1 hour chart shown here, right under the magnifying glass, we are pointing this area, by the way, on the previous slide, on the previous chart. This corresponding area on the 15-inch bar chart, meaning at the exact same time, it shows plenty of great conversion signs to get long the stock. Things like, an oversold oscillator, a strong support provided by the AMA, the moving average 200, and finally a Japanese candle pattern that I use a lot in my trading, which is called the bullish engulfing pattern. And this enables me to get a signal and go long once the price trades above the high of the previous candle. And I can set basically a tighter stops that I would otherwise get on my 60 minutes bar chart. Again, this shorter time frame requires more attention, dedication in front of your screens, but if you do have slightly more time to dedicate, then it is definitely worth it. And this conversion system can be adapted to all sorts of time frames. So here's my recommended triple screen combinations adapted to your type of trading, to your needs, to your time availability. And you know what? I understand at this point, some of you are thinking like, will I have time to trade? How am I going to deal with my full-time job? And at the same time, find the availability for putting in the hours of classroom, whatever, if I'm learning somewhere, if I'm learning on the website, if I'm spending like screen time, practicing. And that is the reason why I am suggesting this table with different combination of time frames which will fit in exactly the way you need them to fit in your actual current schedule. Now, if you can find an hour or so every day to dedicate to your trading, then you could follow the swing to medium term trader plan, with a combination of daily and 1 hour time frames. If not, you could follow the long-term active investor plan, which requires, some study only once a week. But no matter what combination you will have to choose or you want to choose, you'll need to stick to it. So let's say that you fit in the swing medium term stock trader plan, and you use the daily and the 1 hour charts to get into trades. Then stick to these time frames and use those time frames to get in and out of the trade. Do not be tempted or distracted by the market short-term noise, and so don't start paying attention to the short-term unit of times like the 5 minutes or the 1 minute bar chart, because I know that the temptation can be great when looking at short-term trends, intraday trends, but that is why it is important to define from the start your favorite intermediate trading time frame, which basically suits your needs for action, and most importantly your personality and your availability. Okay, so to quickly sum up what we've learned in our second core trading concept. First, you need to follow rules in trading. So use multiple time frame conversions to get the big picture and trade within the main direction of the market using our three core entry setups. Then you need to adapt the multiple time frame to your time availability and personality, like we just talked now. And after that, you need to pick one of the core strategies and stick to it. Make it, your bread and butter strategy, because you absolutely don't need to be a jack of all trades. All you need is one solid strategy, one solid setup that basically you master, along with a good money management, a good risk management, a good portfolio position management. The core concept number one that we reviewed together already. You're only one strategy away in order to make money on a consistent basis. And so now that we've talked about controlling and managing our risk, as well as having a set of entry rules, we finally come to the last chapter of this video. And this is basically our third core concept for successful trading, finding the right stocks or any other financial instruments to trade. So, as you know, there are many different financial instruments. You got stocks, you got ETFs, you got foreign exchange, you got commodities, you got cryptocurrencies. The quantity of candidates to trade is just simply overwhelming. And if you just take, for instance, the US stock market, we're talking about like 20 to 25,000 securities, including stocks and ETF. There are thousands of cryptocurrencies out there. There are hundreds of commodities out there. So trying to find the right stock or the right crypto to play or the right financial instruments, it's like trying to find a needle in a haystack. And that's a huge, huge challenge that every trader faces, especially beginner trader who basically don't really know where to start looking. So how many of you find it very difficult to find the right stocks to trade? I'm sure many of you. Believe me, I struggled myself for a long, long time because before I felt like I had to trade everything. Everything. I have my eyes on the dozen screens, etc. And one day I said to myself, this is ridiculous. You are trying to chase too many rabbits, and at the end of the day, you end up catching almost none. And from that moment on, I decided to drastically reduce my watch list, and that decision really marked a new chapter in my trading. And so now, what I would suggest to you is, especially to beginners, is to start with a short but diversified list of instruments, like one index, say the US index, like the S&P or the Nasdaq, the triple Qs. You could take one foreign exchange pair that you like, something that's a bit more volatile than the others. One commodity like gold, silver, crude oil, and one industry or sector ETF, like the tech sector, semiconductors, the healthcare sector, whatever it is, and see what you like best. Concentrate on these short lists to begin with, get familiar with the process, the method, and then when you start feeling ready to move on from there, then you can start extending the list and make it, wider. Um, if your main idea is to play individual stocks from the start because you're not interested in currencies or commodities or even like index trading, then same thing, start with a short list of four large caps like the Apples, the Facebook, the Tesla, these were the Nvidias, or mid caps, but most importantly they have to be liquid, and then you build up from there. But no matter what you're going to trade or what your short list of candidates is going to be, you have to keep this very important rule, this crucial rule in mind. You got to concentrate on the movers. You got to ignore the non-volatile, the boring trading instruments. And I can assure you that this rule is pure gold. You have to go where the action is and not where you wish the action should be. Because at the end of the day, the volatility is our best friend and it helps us to catch the good moves. So let me show you what I mean by that. For instance, if your thing is trading stocks or ETF, then you should know that not all stocks are born equal in terms of daily trading opportunities. So let's look at, for instance, the Spider material sector ETF, which represents basically a mix of companies within the basic material sector. At that point in time, on that very picture that I'm showing you, it was stuck in a range for weeks, not really going anywhere, moving averages almost flat over that long period of time. This was the wrong sector to be in because during that exact same time, if you looked at the real estate sector, we had a much stronger market with a lot more momentum going, better performance, a defined trend, a moving average with a nice slope indicating the strength of the sector. This was the right sector to be in. And I'm not saying that it was impossible to make money in the previous ETF sector that I showed you, but where do you think it was a lot easier to trade and make money? Let's look at individual stocks, for instance. So here you have an example of the wrong type of stock to trade. At least, I mean, during that specific period I'm showing you now. Again, you can see we're stuck in a range. The moving average are almost flat. There's nothing to do. Trading in that stock at that particular time is nothing to do. And then, if you compare this stock, HGA, to LMPX, this stock here, during the exact same period of time, and then you can understand where your focus and money should have been. Look at the momentum. look at the moving average slopes, the volume, this stock went up 161%, and in not even like 2 trading days, as you can see, on the 60-minute bar chart. So how about this one? MNT, a pharmaceutical company, up 68% in less than 3 days. Or let's look at some cryptos like Dogecoin, up 650% in 7 days at that point in time. Or that one, up more than 1,000% in 6 days. So you see, we can find plenty of trading opportunities every day, every week, if we know where and how to look for them. When we find the right candidates, we just need to apply, number one, the trading setups that we've just learned in secret number two, which tells us when to trigger the trade, and secondly, use our position management guidelines to help us exit at the best time. And of course, number three, you keep our tight risk management to keep us out of trouble. And when we, are either wrong or on the direction or on the timing, everything that we've covered in secret number one. And all of this combination, that's what I wanted to teach you today. Obviously, I haven't gone into all the details because, the idea is to give you the tools to find that needle in the haystack in order to not waste your precious time and money. And so on the one of the very important tool that we use, that I use in order to focus and find the right stocks to trade is the scanner. So some people also call that, a screener. So these scanners, they help us to automate this process of finding the right stocks, the right ETF, the right cryptos, the right commodities in a much more efficient way. And by the way, there are plenty of good scanning softwares out there. The ones I use usually are TC2000, Trade Ideas, Finviz are great for stocks. TradingView for all the rest is really good as well. Now, for those of you who are new to this concept of scanner, you have to understand that they are simply algorithms. They do what you ask them to do. And for instance, what I mean by that, you establish the process and the filtering criteria by which this software will scan a given markets. Let's say, the full US stock market with all its securities, or the entire crypto market, or the entire basically commodities market. And then it will return multiple candidates that validate that search criteria that you have. So there can be as many different scanners as there are traders out there, because each trader is looking for in different places for different things that match their favorite strategy. And so myself, I have a list of multiple scanners that help me filter out stocks to trade according to my different strategies. What you just saw rolling on the screen are some of the scan windows that I use. And so I run my weekend scans to prepare like my sort of A list, my list, to go of stocks and other assets to trade for the upcoming week. And then during the week, I run pre-markets and live trading session scans, which also gives me stocks candidates to day trade. This way, I keep a good top-down approach, focus on the top momentum stocks, ETF, cryptos, commodities, bonds, ETF, etc., for medium to short-term trades. And once I have settled down on my list of names to trade, then I'll just be waiting for my trigger signals according to my three main setups and system that we covered just before. Okay, so I know that's a lot of information that I gave you in this video. It's a lot of like rich content to digest, especially if you're getting started. And obviously, I would not blame you if you told me that you managed to understand only part of it, because some of the material that that we covered today might not be might not be super clear when you're not used to it. Again, it's normal because it takes time to learn new things. But on the other end, I felt like I needed to introduce you to the real stuff, the practical stuff, and not the usual useless blah blah that you might have heard before. And I can promise you that what I shared with you in this video today, although it is just a part of the exact methodology that I use day in day out to trade markets, they are real gems, and they are really the essential concept that you will need to go, you know, to go out there and start trading and investing actively like a professional. So before I wrap up this video, let's quickly recap one last time what we've learned today. All right. So one, risk money position management rules. Preservation of capital, percentage of risk per trade, max loss on daily, weekly, monthly basis, exit strategies, and aiming for 2-to-1 risk reward ratio. Two, a multi-time frame approach along with the three main core setups. They establish our strategic time frame, the screen that keeps us trading in the main direction of the trend, uh, entry setups with reversal, breakout, pullback strategies using our second screen. And finally, the stock market scanners to find easily the right stocks to trade or financial instruments, in order to go where the momentum, the action is. That's it. Now you have almost everything you need in order to set yourself on your journey to trade and invest successfully. And if I managed to teach you something meaningful, and if I helped you, out in some way to improve on your trading, then I'm glad I did, because this was the ultimate goal of this video. And I understand that I might have gone a bit fast to squeeze in all the what I wanted to talk about, and I might have brushed through some of the important subjects, but I wanted to keep it within a manageable amount of time. It's already basically a long video by YouTube standards, and as you might have understood from this presentation, trading is complex. It is a full-time job if you want it to be, or it can be a real hobby, a passion of yours. But unfortunately, it can't be covered in 1 hour or so. I would like, it would like it would be like me asking a helicopter pilot to teach me how to fly in 5 hours. It doesn't work that way. I mean, I wish he could, but even if basically he did, I really doubt that I would feel confident enough to take my first flight solo, even after 5 hours being taught by him. And I'm not saying that flying a chopper is more difficult or less difficult than trading. It's probably more difficult. But what I'm trying to say is that it's something that you need to take time to learn about before throwing yourself into the pit and invest your real hard earned money without actually being really prepared for it. Because if you truly want to be serious at it, if you need to invest the necessary amount of time and have the dedication to master these new sets of skills. But if I could do it, if my students could do it, then you can do it. Now, let's take a an hypothetical but still quite realistic scenario. Say that you're not experienced, but you've decided to have a go at trading. So you also decided that you'll start with a budget, a capital of 10,000. That will be your initial trading capital. Nothing massive, not peanuts either to start with. Now, it's probably fair to think that you're not going to quit your day job just yet. It might be something that you would consider at a later stage, but right now it's not in the cards. But on the other end, you're thinking that you could dedicate an hour or so per day studying for this new project, at least at the beginning when the heavy lifting learning is required. So what would be the best option to go for? Either start with your entire 10k ready to be deployed for trading, go and try it on your own, or spend some time basically to learn, to spend the time to do the right thing. So starting with your 10K initial capital, and after spend, let's say, a training period of 3 months, understanding, playing with the method that you know that you want to basically specialize on, you should be able to emulate the average metrics that we've talked about before in this video. So as an example, if you were to trade like 3 times on average per week, and again meaning entering and exiting a trade 3 times a week, if you could maintain a 55% win rate on average, so again on average being wrong 45% of the time, if you risk on average 1% of your trading capital on every single trade that you take, so in our particular case, it would be $100 of risk per trade. And finally, if your average risk reward stood at about 1.4, like we've discussed on the table, the spreadsheet that I showed you before in the video, then you'd be looking at increasing your trading capital to about 15K after 14 months, and that period includes a 3 month training period, which would mean that you could get a 50% return on your initial investment within 11 months after your initial trading period. Again, nothing is guaranteed or written in stone, but in this simulation, I'm using a small risk per trade, realistic, achievable metrics after 3 months of training. And we're assuming that you could spend an average of 1 hour or so per day on your trading, at least at the beginning. So, generally speaking, it's all manageable stuff. And the fact that most of you who decided to take the time off now in order to basically attend, this, watch this video, tells me that you're motivated. That you're ready to, to learn, to work hard in order to be in greater control of your finance. Because you know what? You could have decided to sit in your sofa and watch basically some Netflix or some like YouTube videos instead with music and etc. But the simple fact that you're still here at the end of this video means that you're serious about making this change in your life. And I don't want to basically do go into psychology and blah blah blah, but like I said before, there are many people who dabble in stocks. Very often they either get lucky or they get poor results because of their lack of knowledge and methodology. It's also crazy to see how much wrong information is out there about how the stock market is supposed to work. But again, no one has to continue to lose money, because at the end of the day, anyone can learn how to invest, how to trade in a smarter way. If you apply yourself, you will succeed. You don't need to be a rocket scientist to become a decent trader or investor. I worked hard, I studied hard in order to get where I am at. But I'm certain that you can work hard too. And the simple fact that basically you've gone through all this video, tells me that you're you you're really focused on that. It's just a matter of you dedicating the time during the week. But if you're really serious about it, you shouldn't have too much trouble finding 1 hour a day. And I believe that most people, whether old or young, they should learn how to save and invest properly as early as possible, because with the power of compounding interest, the income from your stocks investments and in general your investment, your portfolio and your trading, they will let you reach your goals earlier and provide you with real long-term financial security. And again, trading and investing isn't made for the elite. There are hundreds of thousands of individuals who want to plan to be better off financially and reach out to their own financial independence as early as possible. And so, you really shouldn't worry too much. Again, I'm going to repeat myself, but don't worry too much if you're new at this stuff or if you did not understand all the things that we've covered, in this video. Because, at the end of the day, every successful trader, every successful investor was a beginner at some point in time. And he or she, she was, taught by someone, or, they read a book or they attended a seminar, etc. They started somewhere, I, I'm not the exception. And I was lucky, in my particular case, to learn from my mentor in my early days. And you should not be the exception either. Anyone who put in the effort to learn can succeed. But I'm not gonna lie to you. I mean, is trading easy? No, it won't be an overnight change, and it's not a get rich instantaneous quick scheme. This is why you need to invest your time and attention and be disciplined and patient. Do most people make a profit at trading? Again, no. I showed you like 70%, 80% of the people they lose money. But before those, you know, they these guys they never basically spend the necessary time to really give themselves a chance. Those who wins are the ones who took it seriously. They spend the time studying. And is there a magic formula? Again, I've answered that before. No, there are proven techniques which you know can can be learned. Can be taught. I mean, and once you got it, it's there for the rest of your life. You own your skills. They're completely transportable, scalable, and this knowledge that you will acquire, it will pay for itself many, many times over when you start applying it consistently. So, you really got two choices. Either, you stay put and you do nothing, or you move ahead with your plans in order to fulfill your dreams. But I believe that status quo is not the option. And I will finish, this with, a quote of the famous some guy that I really like, a coach, a public speaker, and a really, I'm sure that you've heard of him, like Tony Robbins. It goes like this: you gotta stop being afraid of what could go wrong, and you gotta start being excited about what could go right. Remember that no one holds you back but yourself, and that's how I want to end basically this video. So like I said at the beginning of this video, I'm not sure at this stage what you're trying to achieve by learning more about trading and investing, but I'm certain that you've got one goal in mind. So before you go, why don't you just take a moment to let me know about your ultimate goal? I'd love to know where you are at this stage, of your journey, and if you're already trading and for how long you've been trading for, because I'm sure that some of you today on that video might be brand new to it, or perhaps you've been trading for some time now, but you might still kind of struggle out there on your own, and so you might be looking for a different approach that could take your trading where you want it to be. And by the way, there is no right or wrong answer. It's just basically your own personal answer. So let me know by leaving a comment in the section below. In the meantime, I hope that you will come out of this video with the feeling that you've learned something useful. If so, give me some love, a like, a subscribe, and I'll see you in the next one.